Absolutely. We're also now joined by Larry Shover, Chief Investment Officer over at SFG Alternatives. And Larry, your take on the gold fall, and did you read that Goldman Sachs note ahead of it?
I did not, and I've read it since, and yeah, it makes a lot of sense. I mean, I think what Paul said makes complete sense, but I think what we're all missing is how tentative and fragile our market really is, because really it's no reason except for momentum. I mean, are we in an inflationary environment, a disinflationary environment? Who knows? Is the central bank going to sell? Who knows? But the fact is, it's so fragile right now, and what worries traders in the U.S. right now is something like that. Could that happen in the equity market just on a whim, on just a rumor, or on a Goldman Sachs report?
Yeah, absolutely. I mean, how is everyone over there viewing gold right now? Is it a buying opportunity because it looks cheap, or are people pretty wary?
Well, you know, it depends on who you ask. If you're asking yours truly, I do believe gold's a good buy right here, part of a diversified portfolio. I still think it could be at $1,500 by the end of the year. Right now it's $1,365 US. Really just completely, my premise is based on the fact that we're engaged in this experiment, this monetary experiment that we just don't know what the outcome is going to be, and we do know that the U.S. and Japan are going to continue to print money, and that should be a good hedge for gold. So I would buy it right now.
Yeah, absolutely. But what about this argument that investors have been loading up on gold for 5 years and that it's an investment bubble that is bound to pop?
Well, it could be, but you know, it reminds me a lot of 1971. I wasn't on the floor in 1971, but when you look at the gold price, we had a sharp reversal midway through the year, and towards the end of the year, the bull market resumed. I mean, the gold market just isn't as big as like the interest rate market or the foreign exchange market. It's fickle. And right now it's like people are fleeing the exits because they think that perhaps there's going to be no inflation in our environment, but they're missing the fact that maybe you should own gold because we're printing money and we don't know how this whole thing's going to end up.
Yeah, Larry, also want to ask you about the trigger point. And I know that no one can really come up with one real factor as to why we saw such a heavy fall, but to you, what was the catalyst?
I wish I knew the catalyst, because when it comes to market momentum in the futures markets or interbank FX, I mean, that's the big unknown. That's something that nobody can really predict or gauge, or it's kind of like consumer sentiment or consumer spending habits. We just don't. It's hard to predict. But when we saw Friday's close and we saw the Friday it closed below on the low end of the range, that gave pause to most traders thinking that this thing was going to continue to break farther. However, no one, I mean, not many people thought it was going to break as hard and as fast as it did on Monday.
Larry, what do you think the contribution of ETFs was to this story?
Well, I think, you know, the ETF contribution, especially from last week, Paul, was definitely part of the story because, as you noted a few minutes ago, there was some liquidation in ETFs. What I thought was funny was that there was actually accumulation of ETFs on the silver side. I know silver is a different metal. However, the accumulation of ETFs didn't do anything to the silver market except drive it lower. So I'm sure it had something to do with it. But again, momentum is something that's very mysterious, hard to gauge, and hard to predict.
Okay, Larry, let's talk about momentum in US equities. Right now, you're in the middle of earnings season, or at least at the start of earnings season over there in the States. So far, the results aren't looking too bad. What's likely to drive the market from here, and how do you think things are going to look at the end, at the completion of this earnings season?
Well, you know, right now, as you noted, that most S&P, I think it's like 60% S&P 500 stocks have beaten already. But let's keep in mind that the expectations, the bar is set so low. So I think what's going to happen, we're going to see a slew of banking earnings coming out next week, some of the regionals. Maybe if that tone tends to change, that will change the growth metric. But right now, it seems like most of them are beating. I think the market, the equity market in general, is starting to realize that we're not collapsing, but growth is actually cooling off a little bit. And somehow, for some reason, we're comfortable with 2% growth.
Okay, let's move to Europe now and take a look, because I can see in your note you're talking about the ECB worries shifting to the core. Just talk us through your concerns here.
Well, my concerns are really to the core that, you know, Draghi certainly can't do everything. The OMT hasn't been activated yet. I mean, the recession is deepening. We had a consumer confidence number come out in the U.S. this morning from Germany that wasn't good, and it just keeps piling on a little bit at a time. For a while there, the core was like holding up the periphery, but right now it seems like the core is leaking a little bit. I just don't think, I'm thinking danger right now. And when you look at danger in reference to maybe their credit spreads or their sovereign debt, I mean, I think it's a poor judge right now because you have Japan in there flooding the markets. But I do think something's up, and that might be the growth metric that just pulls the rug under the stock market worldwide.
Okay, let's talk about the yen now, because you're talking about some of the people who've purchased it might need to worry about what direction it's going in. Just tell us what you're thinking in terms of the yen-dollar trade at the moment.
Yeah, so the yen trade's interesting because, again, we're talking about bubbles, and we're talking about everybody piling on, selling the yen and looking for 100 yen and stuff like that. But again, we're having the Bank of Japan coming out with this exuberant program, and I'm not dead convinced that they're going to be able to execute on that. And for now, it's a bubble, but I would be very cautious. And when you look at volatility in the implieds, I think the volatility is saying the same exact thing.
Okay, just finally, Larry, looking forward to the rest of the earnings results that we have out this week. There's a lot of big names still to come. What are you eyeing in particular?
Well, what I'm eyeing is actually a rotation. We're seeing industrials, financials, materials basically just in the dirt right now compared to all the safety stocks. And it would be really nice to see that rotation. It's something we saw a week ago on Tuesday where we did see some high beta chasing. But since then, it's been all safety. So it would be really nice to see financials, materials, and industrials at least start to climb back up. Right now, I have a lot of giant red flags with everybody, just rushing to safety.
Yeah, just one more question. Sorry, Larry. Just wanted to ask about sentiment down there at the CME Group in Chicago after those blasts we saw in Boston yesterday. Are people acting differently or doing their day-to-day activities differently? Did some people hold off trading because of the emotion involved?
Well, sadly, I think we're starting to get accustomed to this sort of thing, and it didn't really affect trading a whole lot. Yes, the market did tank just a little bit after that came out, but I think by the time the market closed was the time when people really resonated what occurred, and we had 8 to 10, 12 hours to let it sink back. So it did not really affect trading a whole lot.
Okay, Larry Shover, thanks so much for your time. We do appreciate it.
Thank you.
Larry joining us from SFG Alternative.